Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsarthi. And in this podcast, we are going to talk to you about how a state elections can affect long-term GSEC yields. And this is specifically to the Karnataka state elections that just got concluded. And why should it have an effect on long-term GSEC yields? Just before we start, if you are a partner, if you're a financial advisor, the best place for you is obviously INR Bonds Partner Portal. See the best bonds available for your clients, select the more with the most information, the best of price discovery, and see the different kinds of bonds that are available for your clients to fit into their portfolios. Log into INR Bonds Partner Portal and see your fixed income assets grow. Coming back to the Karnataka state elections and long-term GSEC yields, right? Now, what is the connection? Why should a state government assembly elections affect long-term GSEC yields? Two things. One is basically the fact that what the elections was won on, and second is how is it going to set the trend for the elections that is going to happen in 2024 for the national elections. And so Karnataka state elections, basically, I'm not even going into the politics of this, but there was a lot of welfare schemes. And so that appealed to the larger part of the population. Now, if you look at states like Tamil Nadu has been running welfare schemes for a long period of time, setting the trend for other states. And Karnataka followed and saw, with the party which won the majority, the Congress party, had one of its main agendas as welfare schemes, and that really appealed to the electorate. And so that gained them the victory in this elections. Now, so going into 24 general elections, where now the, the 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 parties will try to vie with each other across the nation now in terms of floating out welfare schemes to the whole population as a whole. And obviously, when you float welfare schemes, it's basically welfare schemes, right? So the funding is done by the state or the government. And this funding has to come from the main sources of income from the government, which is taxes. And also, wherever they're not able to balance the budget, it comes from borrowings, market borrowings. And so the central government borrows through issue of government bonds. State government borrows through issue of state government bonds, state development loans. Now, if we are moving on, if the country is now moving on to to a so-called welfare state, where elections are now going, welfare schemes are going to be a very high part of elections for both states and central government, then obviously there are two pronged effect on this. One is that clearly when you have spending happening without any kind of productivity through welfare schemes, you give money to the hands of the electorate and people, and they spend. It's basically getting a consumer-driven economy, and in such cases, it has a direct correlation with inflation because spending improves and prices of goods and services rise. Also, it also gives rise to higher cost of labor, and that again increases cost of prices of goods and services. And this is going to be a continuing trend. Now, whether it's good or bad, I'm not even getting into that. And like I said, it's not nothing. It's got nothing to do with the political aspect of it. It's just got to do with the economical aspect and its effect on bond markets as a whole, because bond markets clearly determine the rate of interest in the economy. And here, the particular effect will going to be on government bond yields, especially the long-term government bond yields, because the government is definitely going to borrow more. The inflation is going to be it's not going to be well. It's going to be very difficult to manage inflation, which as a welfare state. And so put together, it's a very highly negative for long-term government bond yields, as inflation is going to rise and there is going to be more borrowing. At the same time, there could be a situation where inflation, where growth considerations lead to lead to the central bank actually not really hiking rates to stabilize long-term inflation expectations, especially if current inflation expectations are lower than what they foresee, or what they cannot really pinpoint what are the long-term inflation expectations. So put together with high liquidity, which is given by central banks to promote growth, the high spending by the governments, both state and the central government, and the high borrowing, long-term government bond yields are set to rise on a longer-term basis. So hence, what it means for investors, wealth advisors, and wealth managers who are allocating fixed income for their clients, clearly, one is it's always better to be shorter term and you get the benefits of short-term accruals on bonds, and taken the current taken the regular coupons that are coming through and the lower maturities, and keep reinvesting, if is as far as given that long-term inflation expectations are going to rise going forward, unless the government sees that it is getting out of hand and they have to control the fiscal deficit and the subsidies. But in the next 1.5 years, leading up to the next 1 year, leading up to the 24 elections, it does look like there's going to be a lot of schemes that are going to be floated by the central government. And also the election plan could be more in terms of the social welfare schemes. So if we could actually be also, if this is going to be the theme of the elections, then clearly it's going to be really negative for long-term government bond yields. So that's where it is. And on the risk factors of investing in bonds, obviously you have price risk, which is prices can go up and down. You have a credit risk. Bonds can default if the credit quality worsens, and liquidity risk that bonds cannot be sold. So investors have to be aware of all the risks, and best is to consult financial advisors on investments in bonds. And do follow us on all podcast channels, and do not forget to download our app Quick Invest by INR Bonds for the best curated list on bonds on offer, for helping financial advisors and investors to navigate this kind of scenarios where for fixed income especially for fixed income, which plays a very large part in investors' portfolio. Thank you very much for listening in.